Good day everyone, I'm Liam Riley Sacker Anliano and I'm here to discuss Tobin's Q theory. Tobin's Q theory is a ratio devised by James Tobin of Yale University. It is the ratio between market value and replacement value of the same physical asset. And here's the formula.
For example, a low Q ratio between 0 and 1 means that the cost of replace a firm's assets is greater than the value of its stock. This implies that the stock is undervalued. Conversely, a high Q greater than 1 implies that a firm's stock is more expensive than the replacement cost of its assets, which implies that the stock is overvalued. This measure of stock valuation is the driving factor behind investment decisions in Tobin's model. 1. The numerator is the market valuation, the going price in the market for exchanging existing assets. The other, the denominator, is the replacement or reproduction cost of the price in the market for the newly produced commodities. We believe that this ratio has considerable macroeconomic significance and usefulness as the nexus between financial markets and markets for goods and services. A general equilibrium approach to monetary theory.
How it is measured? For a single company in finance literature, it is calculated by comparing the market value of a company's stock with its equity book value. And this is the formula.
The following graph is an example of Tobin's Q for all U.S. corporations. The line shows the ratio of the U.S. stock market value to U.S. net assets at replacement cost since 1900. Market hype and speculation reflecting, for an example, analysts' views of the prospect for companies or speculation such as bid rumors. The intellectual capital of corporations is the unmeasured contribution of knowledge, goodwill, technology, and other intangible assets. The company may have not aren't recorded by accountants.
Tobin's marginal Q is the ratio of the market value of an additional unit of capital to its replacement cost. PB ratio. In the case of inflationary time, Q will be lower than PB ratio. Conversely, it will be higher than Q. During periods of very high inflation, the book value would not reflect to the cost of replacing a firm assets, since the inflated prices of its assets would not be reflected on its balance sheet.
Here are the things that we need to remember in Tobin's Q theory. The Q ratio was popularized by Nobel laureate James Tobin and invented in 1966 by Nicholas Caldor. The Q ratio, also known as Tobin's Q, measures whether a firm on or an aggregate market is relatively over or undervalued. It relies on the concepts of market value and replacement value. The simplified Q ratio is the equity market value divided by equity book value.